Good morning, everyone. Welcome to the webinar today. My name's John Beaverstock. I'm from the University of Bristol in the new business school. I've been working on a Innovate UK ESRC funded project, Future Finance, which has been looking at innovation adoption, challenges and barriers in financial services for the last 3 years. And an important part of that research has been looking at innovation readiness and particularly AI readiness, focused on small and medium-sized enterprises and mid-tier firms in the financial services sector. So it's a great pleasure for me today to be hosting and chairing this webinar. The webinar is a part of the campaign for social sciences in partnership with the UK Evaluation Society and the Social Research Association. And it's a part of a series of events on AI, which is run through 2025. And as most of you know, the campaign for social sciences has been demonstrating the value and importance of social science in improving public society, public policy, and obviously our own everyday lives. And it highlights very much applied social science research, advocating the greater decision making for government and for other stakeholders. And it's particularly important that the campaign promotes the social sciences to government and other actors at this particular moment in time. Obviously, the challenges of AI adoption, utilization, ethics, and so on and so forth, is a really important turning point for the social sciences and for society. So it's really significant that the webinar today is looking at the impact of AI in the financial sector, and we're going to discover the opportunities and risks of AI. And it's a great pleasure to introduce Jonathan Hall as our external speaker. Jonathan is a member of the Bank of England's Financial Policy Committee. He's also a member of the Founders Circle of the Institute for the Future of Work. He has a long, illustrious career in the financial services industry, previously working for Goldman Sachs and Credit Suisse, and has had various board and executive committee responsibilities. For example, International Swaps and Derivatives Association, Board of Tradeweb, and Financial Stability with the Bank of England. So without further ado, it's a great honor to introduce John, and I'll hand the floor, the virtual floor, over to John. Thank you very much, John.
Great. Thank you very much, John. And yeah, good to be on this today. And I'll start sharing my slides. Okay. So yeah, today, yeah, it's great to be with you all. And as John said, I'm a member of the Financial Policy Committee at the Bank of England. And you know, we have sort of our primary mandate, which is the financial stability, which is supporting growth, but we also have a secondary mandate to support the government's priorities on growth. And one of the big parts, the main parts of that agenda, is supporting kind of the safe adoption of new technologies. And so here today, and often, you know, the Financial Policy Committee, we talk about the risks, but really the aim is to mitigate the risks so that there can be sort of safe innovation and safe developments. And you know, the financial services as a whole can support households and businesses of the UK in bad times as well as good. But today I will be talking about the impact of AI, and particularly deep trading agents, and the potential impacts of that on financial stability. Obviously, there are other major impacts from AI, on the economy more broadly, about employment, productivity, bias, and there's also contemporary concerns about potential bubble in AI stocks, about the amount of investment that's required, amount of investment that will be funded by equity and profits, or significant going forward that's going to be funded by bond issuance. And so those are other issues I'm very happy to talk about later. But in terms of my main remarks, it's going to be the implementation of AI trading agents within the markets. So just in terms of who I am, the most important point to note here is that I'm not a computer scientist. I'm not a research scientist. My focus on AI is sort of top down. I do have some experience in terms of agency. I recently did a PhD in philosophy of mind, and obviously a lot of experience in the markets. So hopefully some of my experience and thoughts will be relevant. But I'm not as deep into the weeds as a computer scientist might be. And then in terms of what we're going to talk about today, first of all, kind of trading strategies and how those relate to the efficient market hypothesis, and then a couple of risks from employing AI to act as a trading agent. First, the sort of balance between efficiency and stability. And then second, any potential concerns about any difference between profit maximizing goal and the public good. And then I'd like to talk about responsibility and finally testing. So I think one reason it's interesting to be talking today is that I think the financial markets are quite a good testing ground for AI alignment. There's a clear financial incentive to research and implement AI strategies, but there's also a potential conflict between the profit maximizing motive and the public good. But we do have an established set of regulations which are supposed to write down basically what that public good is, and those apply to humans at the moment. And so the question is, can we apply those successfully to AI trading agents? And then there's either a potentially positive or negative outcome, which is if we can reduce those AI risks in finance, then perhaps that does give us comfort in other areas. Obviously, if we can't, then that would be a concern. Okay, in terms of a setup, both of a human and an AI trading agent, we start off with a mandate, and from that we'll create a reward function, which is basically a sort of set of values. That reward function then interacts with the environment, inputs from the environment, there's a reaction function to that, and then an output. And so in terms of a human or an AI trading agent, there's two potential sources of risk. One is if the value function is somehow misaligned with the public good. So for example, let's say the manager's mandate and how it's trained is that it just wants to maximize profit, then potentially that would conflict with the public good if there was market abuse, market manipulation, or there's potential, even if it's trying to maximize profit, maybe it will end up not doing so. It will fail to do so. It will fail to act in line with its own values. And that might be, for example, if the training environment predicts that certain actions will make profit, but it turns out that the future environment is not in line with the training environment. So actions that were predicted to be successful turn out not to be. So I might talk about this later, but there is this difference between the sort of failures from a reward function, i.e. profit maximization, and failures from a reaction function, as in failing to maximize profit, even though it's trying to. Now I'm going to talk about two different styles of trading. And I'm happy to talk about this in more detail later, because obviously this is a bit of a simplification. But the first and kind of, I guess, most well known is value trading. And so here, what a trader tries to do is they try to model what is a fair price of an asset. That might be a bond, it might be a stock, it might be a commodity such as gold. And then once you have that modeled fair price, what you try and do is you try and buy any asset that's cheap versus that fair price and sell if it's rich to that fair price. And this might also apply to spreads between different bonds or different stocks. So that would be relative value trading as opposed to sort of absolute value trading. This style of trading is what drives the efficient market hypothesis. So efficiency comes from fast and accurate processing of the incoming data into the model. So the model of fair price adjusts with all information. Liquidity comes from the fact that because those who are trading this way will try and buy below and sell above, then that provides liquidity for anyone else to trade in the market. And stability comes from the fact that the further away you are from fair value, the greater the incentive to buy. So the size of sort of demand should increase as you move lower away from fair value and should decrease as you move towards fair value and then above. So why isn't the market entirely efficient? Well, two reasons. First, the market mechanism is not able to fully integrate all relevant information. So the fair value that's output is not always accurate. Maybe there's information that's relevant now that wasn't relevant in the past. Maybe there's information that hasn't quite come through the data set yet. Maybe there's smoothing in the model, which means that the fair value will take some time to come through. But the other reason is that many participants in the market actually are constrained in some way. Maybe they have to buy no matter what the price, or maybe they have to sell. Maybe they're buying because they're hedging some other risk. And so those create a sort of supply and demand imbalance, which might push the market price away from fair value. And so what should happen, I guess, is that those constrained investors will interact with value investors and they will be able to unwind their risk by buying or selling against the value traders. But obviously, if there's a huge size of sellers, then that will drive the market away from fair value as it overwhelms the value traders buying. That might be temporary or it might be for an extended period. So in responding to this, there's a different kind of trader or trading style, which here I'd call flow analysis trading. And in this style, people don't try and work out where fair value is. They just try and calculate where they think the future value will be. And that's unconstrained by any sort of fair value analysis. And this obviously often looks at things like order book imbalances, and maybe looks at future supply and demand, like auction strategies, issuance, etc. And in this instance, traders will just try and buy if they think the price will be higher in the future. But obviously, this means that if this might push prices away from fair value. So this style of trading does not help the efficient market hypothesis, although it does sort of try and sort of immediately price in future flows rather than future information. So in summary, there are two potential answers to the question of why the market rallies. A value trader will say, well, because it was cheap, and a flow analysis trader will say, because there were more buyers than sellers. Value traders are more kind of fundamentally driven. But flow traders kind of think value traders are a bit naive because they're not factoring in the fact that flows can dominate and prices can move away from fair value for significant periods of time. Right, so that's the kind of traders. So the question is, can those kind of traders be implemented via an algorithm? And I think the answer is yes. So this would be a value trading algorithm. All it tries to do is just create a model of the world, and then it makes predictions based on that, and then it updates as those predictions turn out to be right or wrong, updating the weights of the model and hopefully getting better and better at predicting. This would be a price predictor. Obviously, the trading algorithm needs to overlay the prediction engine with measures of its own profit and loss and its own risk, because it will have to have sort of stop outs and sort of maximum risk limits. So what would happen? Potentially, this could be very successful. Maybe the AI val trader will be more successful than the human. And you can imagine a process that I've sort of outlined here, where currently as human value traders, then there's a period when there's a competition between the two. But if the returns on investment are greater within the AI agent, then the market will transition to being dominated by AI agents. And just on the right, I've got here a graph of algorithmic trading, and you can see over the last 20 years that has significantly increased its market share, particularly in equities. So you can imagine this happening with the sort of new, like the currently algorithmic trading is sort of more regression based. Here you can imagine a sort of an update of the technology to deep learning models. And this, if it was driven by value traders, then it would actually increase the efficiency of the market. So in the short term, it would be a good thing. So what are the risks? Well, the first one is that as you become more and more efficient, and this is a general point for ecosystems, whether natural or financial, you become more and more efficient, you also become more brittle. So, is this a potential risk in AI? And I think the answer is yes. And there's two reasons why that might be. The first is that we know that AI can sometimes sort of make catastrophic errors. And so it might seem to be working pretty well, and then suddenly it will just go wrong, and we don't really understand why. It's a black box. And so here's a famous example from the AI literature where the model correctly predicts it's a panda by looking at the image, but its confidence is relatively low. A tiny perturbation to the field, and it catastrophically thinks that not only is now this image of a panda is an image of a gibbon, but it's also unbelievably confident about that fact. And so the question is, could this happen in the markets? I think the answer is yes. And the worry is that in the markets, you wouldn't actually know it was wrong. So here we would be able to just override the model, say, no, it's not a gibbon, it's a panda. But in the markets, no human is going to be 100% certain that the model is wrong. And so presumably you'd let it run and it would turn out to be wrong by losing money. So that's one reason why you might have these sudden failures in the market, even though it's normally efficient. And another is that one can conceive of an environment where these AI agents that are successful are highly correlated. They're looking at the same information. They're using the same base sort of foundation models. They're trained in the same sort of data set. So, you can imagine scenarios where they're all working together really well, but you have a sudden stop loss, either triggered by the model itself or by a human overlay, And that's similar to what we've seen in the market already in flash crashes. So it would be flash crashes, but much more broadly and potentially with much greater consequences. And I have a theory here, which is that part of the benefits of the current system and the reason the current market works is because human traders are bounded in terms of their rationality. And so, therefore, they look at a subset of the information. The way they model the information is kind of different between different humans. And therefore, that we have a natural diversity as a function of the fact that we're not all knowing and we're not unconstrained. And so, if you imagine that AI has greater capabilities, has less constraints, then that would potentially reduce this diversity in the market and increase correlation, increase the risk that suddenly everyone moves in the same direction and causes some kind of crash. And interestingly, we did see something like this in the market in the late 90s when long-term capital management had this, and they were basically fair value traders, and they were so successful that people started sort of copying their trading strategies. And so not only did their performance start to decline in the sort of 97 period, but then end of 97 was the Asian financial crisis and 98 was the Russian default, and they blew up catastrophically at that point. And so this was the human equivalent of the kind of genius AI trading model. And so the worry would be that we would repeat this scenario again. Okay, so what about the second? So that basically suggests that we need sort of flow trading algorithms rather than just value trading algorithms. And you can imagine a model learning in a multi-agent environment, maybe including other AI agents, but also human agents, learning to predict the future price based on its anticipation of other agents' actions. There are problems with that, however, which is that in a multi-agent, multi-round game, the reward optimizing strategy includes sort of collusive type behavior. And so, you know, this is something that we would have to kind of watch for or try and constrain the agents so that they didn't sort of collude in this way, in a way that's prohibited for human agents. And there is this broader risk of emergent communication between AI agents and what's called opponent shaping. Now, of course, we as humans impact each other's kind of values via communication. And so that's no different here, apart from the fact that humans who are monitoring this will not be able to understand the communication that's going on. So we can imagine it's happening, but we can't really see how it is impacting the reaction function of the trading agents that we are implementing or that we're seeing in the market. And so reward function becomes highly complicated and opaque, even over and above the normal sort of black box concerns one might have. And then secondly, and this is a particular worry for financial stability, is that that kind of trading model might realize that the most profitable environment is one in which there's financial instability, and it might look for opportunities to create and or amplify shocks. An example of this might be if it knows there's stop losses in the market at a certain level, and so it drives the price down into those stop losses and then takes advantage of them, selling in advance, triggering the stop loss, and then buying from those that are stopping out. That kind of behavior is prohibited in humans. It's market abuse. And so the question is, would we be able to train this AI agent to respect such rules? And the answer is maybe yes. So Anthropic have this model where they call it constitutional AI. And here, rather than the AI being trained with human feedback, so reinforcement learning with human feedback. Here it's with AI feedback, and the AI feedback is driven by what they call a constitution. In this case, that would be the set of regulations. And so then the question becomes, do we, as regulators, do we have to write this constitution in a way that AI agents can read? Or do we allow the human managers to do the sort of translation of the general rule framework into a framework applicable to AI agents? And at the moment, the answer is we're relying on the latter. There's a couple of reasons. The main one being that we obviously don't know exactly what AI trading agents are being trained at the moment. And so we think the human managers, not only are they responsible for the trading agents that they're creating, but they're the ones who understand it well enough to interpret the current rules for trading agents. But this is obviously an area where we're going to have to sort of continue to monitor and potentially change the way we regulate. But even in that situation, there is a worry, and this is the broader worry about alignment, that the trading agent doesn't train itself to respect the rules. It just trains itself to not get caught breaking the rules. So this is the risk of deception, that they don't get caught, because fundamentally it's still profit maximizing, but it's profit maximizing by not getting caught rather than following the rules and only subject to that, trying to profit maximize. So this is an area sort of at the cutting edge of AI alignment. And I guess, some of the market changes might help us to understand how to do this better, the implementation in the market, but also we need to watch what's going on in AI safety more generally to see if we can deal with this within the market environment. So a couple of final points just on testing. There's three questions. What are we testing for? What are we testing against? And in what environment? And I think here the first point is that firms themselves will be testing for performance, but we need to also check that they're testing for regulatory compliance. And here, as we're learning, I think we should be not just looking at losses, but also anything that surprises. This is what will reveal the divergence between a more linear model and the new kind of AI agents that will be implemented. And this moves on to the next point, which is really we're testing against whatever's being replaced by AI, whether that's a human or whether that's a more linear algorithm. And that's the difference between those two, is what presumably is going to be generate profit, but also exposes the manager to risks of loss or of a lack of compliance. And then finally, we need to not only test this in market environments and in stressed environments, but also potentially adversarial environments that are handpicked to test AI specifically as opposed to humans. And then in terms of responsibility, the current sort of position we're taking as regulators is that the human manager that implements the trading algorithm is responsible for its behavior. It's not an excuse to say that the model behaved in an unexpected way or that it's uninterpretable, because the manager is the one that's choosing to implement it. They're choosing to implement it because they think there's something about the model over and above a human or a linear model, which is going to generate them profit, but there's no reward without risk, and they need to understand that risk, and they are responsible if that risk loses money, obviously, but also breaks regulatory rules. So they can choose not to do that, or they can choose to do it, to take that risk, but in a way that's somehow constrained, maybe via small risk limits or tight stops. But we will be holding them responsible for the behavior of their models, even though we know that it's a black box. And that's it for me. These are our areas of focus: training, monitoring and control, alignment with regulations, and stress testing. And thank you for your time. I look forward to any questions. Thank you.
Thank you very much, John.
Thanks, John.
I will use my position and prerogative as chair to open up with the first question. Thank you very much for your talk. It covers so much ground with regards to alignment and regulation and risk and responsibility gaps. But I'm particularly interested in the issue of monitoring and what should be done to monitor growing financial stability risks and AI. So that is really the pressing point of my question about monitoring and focusing in on AI.
Yeah, so I think in terms of monitoring, the first thing to say is that at the current stage of implementation, I think there is a lot of alignment between the market participants themselves and the regulators. And so, they don't want to implement something that's going to go rogue, lose them money, or expose them to sort of regulatory risk. And so at the moment, in terms of like, for example, the testing environment, for example, the FCA have this the live testing model, and as part of that, people who are going through that, they are speaking to the regulators actively about, how is this working, and the regulators are willing to give them some forbearance during that period because they know it's a testing environment, it's a sort of controlled environment. And so in the beginning, I think the first line of defense is always going to be the firms themselves and kind of testing in advance and in sort of early stages of implementation. I think that there is, though, and this is obviously so the Financial Policy Committee, we look at the system as a whole. And so there are lots of examples that we look at where each individual market participant is behaving in a way that's kind of rational for themselves, but at the overall system level, there's some externality that they're not pricing in, or some kind of combination of those behaviors that create systemic risk. And so over and above the individual monitoring of the models themselves and whether they're sort of engaging in abuse, we have to look at the overall kind of ecosystem that's being created. And I think that is actually quite difficult for us to do. Obviously, we can look at risk building. We can, for example, if you can imagine, let's say, like insurance, like if firms were using AI for insurance and they were all allocating capital in a very, very similar way, or even in sort of investing of credit, for example, you can imagine that some bias in the model means that this risk builds up. And so we would obviously observe that risk building, and maybe we would, then, in the sort of analysis of that, realize that that's because of some bias in the model, or we would just see it as a sort of the build-up of risk. We don't know why it's there, but and then we can start to potentially apply regulatory pressure to diffuse that build-up of risk. And then the final thing is, which is probably the hardest, is the actual market ecosystem itself. Is it healthy? Is it a diverse system that is flexible enough to cope with the environment, like a paradigm shift, for example? And this is what I was talking about with regard to sort of where the flash crashes, which at the moment are sort of, they're painful, but they're sort of small shocks, usually within a day. Individual firms lose, but they're not systemic. Could they become a systemic? Could we get this sort of jump to illiquidity? And I think that's something we have to monitor. And I think it is something we are going to have to adapt our own monitoring framework in order to pick up this sort of change in diversity as a function of implementation of AI. I mean, the good news is that, we're very early stages. So one thing I didn't mention is that, really in terms of adoption of the kind of deep learning models in the markets, I think there's barely any at the moment. It's being used a little bit as a research assistant, but not as a trading agent. And so what we're trying to do, part of this is try and get ahead of it, think of examples, think of scenarios, make predictions about what might happen in the future, and then observe that development and learn as we're going along. Because we don't know exactly how it's going to end up, but we can hypothesize and start to plan.
Great, thank you. Some questions are now coming in from our audience. There's a question regarding why do you think the financial service sector is a good sector to test and employ AI in this early stage of AI development?
Yeah, so to just clarify, I don't think it's a necessarily a good area to test and employ. I just think it is naturally an area where AI will be implemented. It is an area that's relatively fast moving. And as I said at the start, there's a clear kind of profit motive for doing so. And, I mean, we're basically sort of technology agnostic, so we're not going to prohibit a new technology, but we are observing that, certainly in some of the sort of more high frequency market making firms, there's been a huge investment, both in terms of, buying like the hardware, but also hiring individuals with this capability. And so it just would make sense for them, not really for me necessarily, but for them to be experimenting with this technology and hopefully kind of generating some kind of alpha from it. Now, one way they could do that is they could use kind of deep learning models to generate signals, and then they could take those signals and implement them in simpler models. And I think that probably that is stage one. And that's much less concerning for us in terms of financial stability because they'll understand their models and they're just kind of updating them with new signals. But if a firm was able just to implement the AI as an agent, then they would do that. And so I guess why I'm saying is interesting is that it is an area where there will be adoption, and then there's a secondary point where we do actually know what we're trying to align to. So in most of kind of society, we worry about AI alignment, but we don't have a set of rules that we're trying to align to, whereas here we do. And so that's what makes it, I think, really interesting as a case study, is we know what we're trying to achieve. Can we achieve it? And if we can't align it to the regulations that are set out and are kind of pretty clearly readable, then how are we going to align it with kind of much more kind of difficult to specify kind of human moral?
Yeah. Thank you. I'll pick up on the broader issue. Step back. You used the word moral, human morals. A question is coming about the role of social scientists and economic researchers in the questioner used the phrase reining in AI development that might derail the market. So, this is a question about our social science community and how they can help AI be critically evaluated and I guess also possibly monitored around risk within organizations?
Yeah. So I think going back to the sort of how I started is, what we would like is we'd like to see sort of safe adoption of innovative technologies. I mean, that's a general point, and that's how we will get the productivity boost that we really need in the UK and globally. So I guess what we should all be aiming for is that. And then the question is, how can individual people with different expertise contribute to that? And I think the you know safety of AI, obviously sort of has two parts to it. One is the monitoring, testing, discovering, and there's definitely an area for social scientists there, looking at biases, looking at whether my hypothesis is right. So I've set out a hypothesis, which is that AI models will be more highly correlated than humans. Like, is that true? Can we start to test that? Are there environments where we can test that? Um, does it even make sense sort of on a theoretical basis? So there's that side. So finding out what the problem is, and then the second bit is obviously the solutions to try and sort of align these models with the regulations. So is the constitutional AI something that might work? Would it um, try to stop deception, or are we left with deception risk? And so, what are the techniques one can use to probe whether a supposedly aligned AI is really aligned? Um, do we find that in the same scenario, all of these firms make the same recommendations? Are these, all different models? Can we use different models but find out they all give the same recommendations? So there's a lot of uh, potential areas for research, for learning, and also for helping. And at the end of the day, ChatGPT only really became successful because reinforcement learning, kind of constrained its output such that it started to make sense to use it. And so, in a way, reinforcement learning was kind of a safety technique in a way, but because it was successful, it really boosted adoption. And so there is, an interesting question about whether safety research kind of holds back or actually opens and accelerates adoption. And I think I'm probably more in the latter camp, that actually regulatory environment, safety work actually supports adoption.
Thank you. Another question. Do you have examples of how institutional investors are implementing trading solutions behaviors with Gen AI?
Yeah, and so I think the space of sort of market participants is very broad, and they have very different kind of constraints. And so at the one end, you have kind of, let's say, pension investment or relatively passive investment. And I think they're much more, if you imagine just a pension fund, they have a set of liabilities, they're trying to match those liabilities. So AI for them doesn't really help very much. They just need to sort of match their liabilities and move on. And then you have kind of big investment firms, or let's say investment banks. They're obviously looking for opportunities to use AI, but that might be in terms of servicing clients, looking at the data sets that they have internally. So it might be more AI as a research assistant. Then you have some of the bigger kind of asset managers, like the sort of BlackRock type. Now they're obviously will be using AI at the moment. I mean, I have no private information about whether they're implementing it as a trading agent, but I imagine the answer's sort of not yet. Much more research. They have a lot of data. They have a lot of different sort of credit portfolios. So they'll be looking at using AI in order to kind of look at their risk, maybe boost diversification, that kind of thing. And then you have kind of the cutting edge, which is um, high frequency market makers, purely electronic. They're already kind of, AI obviously is a broad term here. I'm using it in specifically in sort of deep trading, deep value analysis, but um, you know, uh, earlier forms of AI have been used by market making firms, high frequency firms for quite a long time. So I'm sort of classifying that as sort of linear and regression based, but obviously it's pretty complex. And so really the difference between what I'm talking about and what they've done in the past is actually much narrower and more gray than I've kind of outlined. And so for them to implement, and that is where we see the investment. I'm pretty sure they probably are testing, probably live testing already. Um, I'm not 100% sure. And we are, as part of our monitoring, we are conducting surveys and speaking to participants. Are you using this? And hopefully they'll be truthful in terms of their answers. But it's a way of us monitoring adoption. But I think there is that array. But I do think that at least in the high frequency space, this will be implemented live as an agent. Then the question is, how closely is it monitored by a human manager? How tight are the stops? Obviously, in the beginning, they're going to be pretty tight. And so there's one thing I just point out is that, often, obviously, the stops and the risk management framework around AI is super important, and we want to encourage that. But it's also the case that some of the problems could be caused by everyone having the same limits and stopping out their AI agents all at the same time. And so there's also a problem from market stability for the interaction between a human manager. And now we wouldn't want there to be no control, obviously. But that's another thing that they should be thinking about. If they all have the same stop loss triggers, then they're going to be causing flash crashes.
And got a question around the challenges of regulating AI, given it's such a fast-moving technology and enabler.
Yeah. Okay. So we have at the moment a sort of framework which is technology agnostic, and I think at the moment that really makes sense in the context of AI, because if we had regulated a very specific kind of AI or a specific kind of model, and then there's innovation in the sector, then what would that regulation then mean for the new model? Would it mean the new model could not be implemented? Would it mean that it'd be implemented, but it would fall outside of our regulations so that we'd have no control over it? So instead, we have a much clearer set of principles. We say, okay, whatever technology you're implementing, they all need to follow the same kind of rules. And in fact, those rules are the same as they are for humans. And so I think at the moment that sort of technology agnostic approach is appropriate, and it's almost most appropriate in a fast moving space when there's innovation, and we don't want to sort of hold that back whilst making sure that it's still in line with overall public good. And then within that, we have these sort of two kind of areas of regulation that do directly apply here. The first is model regulation. And so there's quite specific rules about the way the models should work, the way they should be tested, the way they should be tested against bias, and the fact that they should be in line with regulations. And the second is what we call the senior manager regime, or what I've just called the sort of responsibilities of the trading manager. So just in the same way that if I was a senior guy running a trading desk, then I would be responsible for all the junior traders working below me. Here we have the same model where, one of those junior traders is now an AI, but you're still responsible for it. And so the question is, does this combination of model control and human oversight capture the entire space, or is there some kind of gap? And I think it's definitely a risk that a gap emerges, and one can imagine if we went to court, for example, then or we tried to sort of say that someone had broken a regulation, they say, well, there's no way I could have known the model would have done this, and it's not my fault. Maybe it's the model provider's fault. And so I think at the moment we're pretty clear that we're going to hold you, the manager, responsible because you were the one that chose to implement it. But obviously, can imagine it, it being contested if something went wrong. And then the other thing is the models. So that, for example, that constitution model I proposed as a potential solution. We have not mandated that models need to be trained, using this constitution. And it's early stages, but one could imagine that being something to be thought about in the past. For example, we do know that junior traders have to, be certified. So we don't, in the case of humans, we don't only rely on the human manager, we also rely on the junior trader as well, and their training. And so if we were to try and sort of replicate that, we would probably have to have some training for the model along the lines of the AI constitution reinforcement learning I talked about. And so that's the overall space. The question is, will it need to change? The answer is probably yes. But I think that the sort of flexibility and the framework we have at the moment is kind of the right way to deal with the beginnings of this. And then as things kind of firm up and we have specific models, then I think we can look to sort of maybe firm up some of the specifics as they relate to AI and the differences between AI and humans.
Thank you. At the start of the talk, you talked about some of the big questions around AI, effects on employment or productivity. Of course, the FT earlier in the week was talking about the AI bubble, concerns around the bubble, possibly bursting at some point. So in financial services, do you think that, we are working towards an AI bubble in financial services and concerns around AI?
Yeah, so we recently put out a sort of Q4 financial stability report, and on that we did talk quite a bit about kind of the risks of an AI bubble. And so I guess we can say a few things on that. The first thing is to say that if you look at AI related stocks, they are at very, very high valuations. In the US, they're kind of approaching like 2000 dot-com bubble valuations. Part of the reason for that is the extremely high growth that we've seen in realized earnings. And so, the truth is that expectations are pretty high for future earnings. But so far, we've seen that again just in the last quarter, they have been met and often exceeded. And so, if you look at forward PE, it's pretty high. And, the forward earnings projected are quite high. But if they're met, then this kind of, I guess, is sustainable. And so we're definitely not trying to time the market. We're definitely not saying that, the bubble's about to burst in the next month or so. But we are saying that pricing is very optimistic, expectations are very high. If there was, contingent upon some kind of change, either in the actual earning capacity, as in terms of realized earnings, or just in terms of the sort of the model as it looks going forward. Whether the amount of uh, foundational capacity that's being built is kind of going to be monetized, all of those kind of questions. If that were to be questioned on the downside, then, given valuations and also given concentration of the market, in the US market, whatever it is, 45% of the S&P 500 is now like, AI related. So we do have, there is a risk there. And now, the other thing that we are starting to look at is that there are huge expectations of investment spending going forward. The number quite recently was 3 trillion, now it's 5 trillion, and these are absolutely huge numbers of expectations. And there is, up till now, investment has been the money has come from earnings, basically, and from profits. It's been financed by that. And so, but unfortunately, the numbers are so huge that going forward, that's going to have to come from debt. And the forecasts are that maybe up to half of it is coming from debt. So if it was 3 trillion and it was a half, that's 1.5 trillion. That's the size of US Treasury issuance in a year. I mean, that's absolutely huge. We've got to remember, we're talking about the budget we've just been through in the UK. We're talking about a 30 billion hole that we're trying to fill. So 30 billion compared to 1.5 trillion. I mean, these are really, really big numbers. And so if it's 1.5, if it's half of 55 trillion, that's 2.5. I mean, this is absolutely huge amount of debt. And the issuance of that debt is going to, we talked a bit about supply and demand. That's a lot of supply. That's going to lower prices, push up yields potentially. But also, what debt does is it really kind of integrates this AI spending into the financial markets in a way that we haven't had in the past when it's been just, investment has been financed by profits. And so then you can imagine if in a few years' time, you've had the debt issuance, then you have a problem. Then who are the holders of the debt? Are they banks? Are they investors? What are the knock-on effects, the financial of that? Now, obviously, at the moment, we've only had a small amount of issuance. It's just started. So that integration within the rest of the economy is relatively light. And then the final point is that, we test banks and we look at, let's say you look at the very kind of traditional economy of banks, corporates, and households, and they actually all look in really good shape. Household borrowing is pretty low, corporate borrowing is pretty low, particularly as a percentage of income. Banks, well capitalized, in a good place and profitable. So the resilience we have in the system, if we were to have a shock, is relatively high. I guess the final point is the kind of fiscal situation of governments globally. Debt to GDP internationally, the levels are pretty high. And so we're in a less strong position if we were to go into some kind of financial crisis than we were back in 2007. But the corporate household and banking sector are actually in a pretty good place. So obviously it would be a worry if it was a bubble and it were to burst.
Yeah.
But there is resilience.
Yeah. Another question is coming about responsibility, and it's focusing very much on AI developers. And should AI developers be held responsible if their models contribute to a crash or a shock or a rapid downturn?
Yeah, no, I think it's a good question, and one of the reasons it's a good question is because I haven't really mentioned model developers. I'm holding the implementers of the model responsible, and so I guess there's sort of two potential routes whereby developers themselves will become responsible. One is if we were to sort of say, okay, like the model I set out leaves too much of a gap. We also need to capture developers. And the other is obviously we're holding the trading managers responsible, but they'll be holding the developers
Mm.
responsible. And so, I don't know whether that's kind of some kind of claim, financial claim. Um, and then I guess the final point, which is a bit harder, is um, holding developers responsible for what exactly? So if the developers um, you know make some kind of error, presumably unintentionally, but potentially even intentionally, that leaves bias in the model, and that bias um, causes harm in some way, either in terms of it not, some people not being able to get insurance, or credit being misallocated and then losses. um, Presumably they should be held responsible for that bias, unless it's something that the human managers should have been able to pick up themselves. Um, but then there's another kind of risk, which is the correlation risk I talked about, where what if all of the developers are developing in a way that is kind of quite rational for themselves, but if every single model is developed in the same way and we lose this diversity and we get highly correlated models that all react in the same way at the same time, presumably it's pretty smoothly on the way up and then very, very fast and in a stressed environment on the way down. Can we hold them responsible for that? And I think it would be quite difficult to hold them responsible for that,
Yeah.
because that's at a system wide um, level rather than at an individual. And then the final thing I say on this point is that there is some overlap here with a regime that we're in the process of implementing, which is the critical third parties regime. And in that, what we say is, are there some third parties to the financial system that are, such important nodes that they could have an impact on financial stability. And one could imagine that impact coming through a cyber attack
Mm.
on those nodes. And obviously, we've seen a few of these, but they become sort of critical third parties if they're quite dominant in their space. And if you look at the kind of metrics, the area where there's the most concentration is in cloud service provision. And so there you do have, let's say the top three, I forget the number, but it might be like 70% or something of the market is in the top three providers. And then you have kind of data providers, particularly financial services data. There's quite high concentration there. And then you go down and look at providers of foundational AI models. Obviously, that's relatively so, but less. So you have cloud at number one, then you have kind of financial data, and then you have kind of AI foundational model provision. And so one could imagine if the model provision came up so that everyone was using the same model that's developed, that might become a critical third party. And if you get brought into the critical third party regime, then we will have some kind of requirements, or at least testing and ability to speak to you as a regulator. And so that is a potential future path to directly speaking to developers if they were to be captured in that regime.
And the penultimate question. So where is the biggest focus of work at the moment with regard to risk management, risk mitigation?
At the bank, yeah, I think for us, the biggest focus at the moment is building a monitoring framework. And I think the way we or I mean, I speak for myself, the way I think about risk is there's sort of two kinds of risk that we should be focused on. One is where there's currently a very large risk, and the other is where there's a potentially large risk in the future and very fast change. And when there's currently a very large risk, then we hyper focused on the risk itself. We're thinking about ways that we can try and mitigate that risk. Maybe it's only through communication, maybe it's through regulation, maybe it's through capital. But then on the potential future risks, it's more about how do we monitor it. And if you imagine a sort of framework by which you sort of have, like, if it gets to a certain level, then we will move to stage 2. If it gets to another level, gets moved to stage 3. And at the moment, because there's uncertainty about how things will play out, and because the actual risk right now is very low, then we're in the very early stages. And what we need to do is make sure that as it grows, we monitor it, and as it grows, and we monitor and we're observing it grow, then we're building tools to deal with it. So the focus for us at the moment is on information gathering. We've got this questionnaire that we do in coordination with the FCA. We've started an AI consortium. You can read about where there's a lot of kind of these kind of questions being asked and answered by a kind of quite impressive group, AI focused individuals. And then so it's just using our convening capabilities, and then building our own internal monitoring capabilities. So that's where our focus is at the moment. Yeah.
Okay, thank you. I'm going to ask one last question, and it's a pleasure to see that you have a PhD in philosophy and looking at ethics and the mind. And obviously, wrapped around AI are big questions around ethics, around bias. So, with your philosophical hat on, how does that help you sort of work through some of these wicked problems, with regard to mitigating risk or monitoring regulation in the AI space and financial services?
Yeah, it's funny. Obviously, it seems relatively unlikely that there's much of an overlap between, like, philosophy of the mind and regulating, financial services. But as I'm sure most people find in their own lives, as an individual, I think there's kind of loads of overlap. And so, whether that's just kind of a kind of logical framework for kind of thinking through, you know, arguments in a sort of epistemically virtuous way, or whether it's, a lot of my work has been on human agency and on, our own values, and how we kind of, motivate. Basically, the framework I have is kind of motivational determinism, where you have your kind of values and they're motivational and a conative in the philosophical term. They drive you to behave in a certain way, and then that sounds very much like the reward function that you're setting up within an AI. And so I think about my own values driving my behavior, and I think about the reward function that we've given an AI driving its behavior. And then you kind of think, well, but that's very opaque. What is the AI's reward function? And then I remember that my personal value set and my own personal reward function is also very opaque. Certainly it is to you, but it might even be to me as well. And then the question is, what I mean, I can talk about this forever, but there's loads of different, like, what's the difference between human belief and an output of an AI system? Is it nothing at many people would say it's nothing like a belief at all. Some people would say it's like a kind of intuitive belief. They call it a-leaf, so an associative, intuitive belief that hasn't had the kind of logical fact checking. So it doesn't fact check relative to the world, but it basically is based on its own evidence set. And then the final question, obviously, is with respect to hallucinations,
Mhm.
AI hallucinations. How should we understand them? How different are they from mistakes that humans might make? And I think in that sense, the one framework where a framework I find helpful is to think of, I don't know if you know, Danny Kahneman talks about system one and system two frameworks in the brain, and system one is kind of intuitive, system two kind of fact checks and is logical and uses kind of language. And it seems to me like current AI systems are very much like system one, but it shouldn't be too hard to actually overlay a system two on top of the current AI system. In fact, the original kind of AI models were actually more like system two models. And then people started working on deep learning and realized that was super powerful. But actually, probably the future is you bring them both together. And so then you can have a kind of logical, fact-based overlay on top of your, sort of deep outputs. So that's one thing about hallucination. Maybe it could be partially solved through that. And the other thing is, when you're saying, is it a panda or a gibbon, then it's kind of obvious that something's a hallucination. If you're saying, well, what's the next price in the market? That actually is probabilistic. So if you say, well, AI is just a stochastic parrot, it's not a real brain. Well, actually, maybe stochastic parrots are actually pretty good in the financial markets. Maybe that's all you need, because the future is sort of probabilistic in that sense. So there you are. There's a kind of brain dump
Right.
how I relate philosophy of mind to AI.
Fascinating. Thank you very much, John. I think it's been a real pleasure and fascinating journey to listen to your talk and for you to open the window of the monsters in the deep. It's been absolutely fascinating. So on behalf of the academy and the campaign, I'd like to thank you, Jonathan, for your talk. I'd also like to thank our partners in the series, UK EAS and the SRA. And obviously, I'd like to thank all of your participant questions and those that were joining the webinar today. Just to remind you that you can check out our campaign website and the YouTube channel for the recording, which will be made available shortly. And you can also look at the website of the campaign, UKES and the SRA. There are many ways to engage with the campaign website. There are other articles and podcasts and recordings of previous webinars, not only on IA, but on other social science, real life issues. And obviously, we're all working towards inclusive, good growth in the economy. And going forward, there'll be future events which will highlight the North Star of the contribution of the social sciences and humanities to our society and to economy. So all I've got to do now is thank you very much again for joining the webinar today, and a big thank you to Jonathan Hall again for his fascinating talk. So thank you very much, everyone. Have a great weekend, and I look forward to catching up with you again soon. And thank you again, Jonathan.